Hello, everyone. Welcome to the market update here for Tuesday, November the 29th. Can't believe that November is almost in the books. Seems like it's flown by. Hope everyone had a good Thanksgiving weekend. It's kind of nice to get back to starting to get back to normal market conditions, normal market volume. Boy, most of the days last week were really light volume days, especially on Wednesday and Friday, and those days are hard to read because the market can break in any direction. It's hard to kind of forecast which direction it's more likely to go in. Before we get started, though, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com, Jerry at TradersPro.com. I'll be happy to answer those for you. Now let's get started as far as the update's concerned. Now, before we get into the technical analysis, there are a couple of dates that could move the market a little bit upcoming here. Again, I don't like to focus too much on news or kind of fundamental reasons why the market could move, because basically, as a technical trader, you believe that all that is going to be incorporated into the chart. But we do know that news does move the market, and so really what I try to do when I'm analyzing the charts is, and the process I'm going through, and those that are new, that are joining for the first time or just barely started, you'll notice a common flow to how I do these updates. And it can get kind of boring because it's at least the initial part of it's the same, but it's all designed to try to get a gauge of what the market trend is and what the market mood is. Now, what do I mean by market mood? Well, just think of yourself. If you wake up in a bad mood or sometime during the day you're in a bad mood, how do you react to things in that mood? You tend to probably overreact to negative things that happen to you when you're in a bad mood. And you probably tend to underreact to positive things that happen. Somebody smiles at you and says hi, and what do? You bah humbug them, right? Or something like that. It's like, don't bug me right now. You react differently because of the mood that you're in. Now, you flip that over and you're in a really great mood. You tend to dismiss negative things that happen to you during the day. And you tend to really embrace the positive things that happen to you during the day. Now, the market is that way as well, because what is the market? The market is just a group of humans interacting with each other. And so what we try to gauge is not only where the trend is, but what is the market mood, because it can have an impact on how the market is likely to react to these events. For instance, this week, tomorrow, Chairman Powell is going to be speaking before he goes into a quiet period before the Fed meeting next month. Now, we know that the market has really been focused on what the Fed is doing, what the Fed is likely to do in the future, and so they are really going to be listening to every word he says whenever he speaks, whether it's in front of Congress or at a news conference or in these speeches that he makes. So, if we can gauge what the market mood is, that could help us maybe gauge how the market might react to whatever he says, because we just don't know how the market's going to react to what he says. So again, the point of this exercise is going to be to try to, again, we're still not going to know exactly what the market will do off these things. The market trend and the market mood was looking like the market should drop a few weeks ago, and then that CPI report came out, and so the market mood was somewhat negative, and it felt like whatever that CPI report news was, the market was likely to go down on it, and it did the opposite. It spiked up pretty dramatically. So I don't want to imply that gauging market mood is going to lead to knowing exactly what the market is going to do. We still can't know that, no matter what we do, no matter what we analyze. But it can at least help. It can be another tool that we can use in helping to increase the probability of getting that direction right. The other item, and I think I mentioned when I talked about this earlier, I think I said it was like the 7th or 8th of December, but it's the 4th of December is that OPEC meeting. That's something we'll want to pay attention to, because obviously what oil prices, or there's a really long question here. Can you email me that question? In these live classes, I really can only focus on a small question. And I really want to, if it's a longer question, I'd like to probably be able to address it through an email. Sorry about that. It's just, I see, it's intimidating when you see a big long question and you're in the middle of a live class to try to read the question and then interpret how to answer that. So anyway, sorry about that. But getting back to December 4th, again, we don't know where oil is going to go off of that report, but we can look at the chart of oil and gauge kind of the mood that the market is in, and at least be aware of that going into that news event that could end up moving the market. Okay. All right. Now, starting off, we're going to take a look at what we're looking at right now are the direction alerts. This is giving us an idea of whether the market is overbought or oversold, and this ties into the market mood. If the market is really overbought, there's a tendency for it to come down, or more likely to pull back or come down a little bit in the near term. If it's really oversold, it's more likely to kind of rally a little bit in the near term. If it's right in the middle, it's not really telling us, it's not showing any major extreme. And so, it could go either way. It's basically what it could do when it's kind of in the middle. The long-term trend is still the same. We're in a bear market, although I do want to point out that we are seeing it. This is kind of showing you the longer-term bear market trend. You can see that it's starting to tick up a little bit. Now, it did that right in here and still ended up going lower again. So it's not necessarily saying that we bottomed out. In fact, if you've heard me talk for several months now, I've been saying that I just don't think the market's going to be at a bottom until we get a panic sell-off. It just, none of these market bottoms have ever bottomed without a panic sell-off. We just haven't had one yet. We've had some concerned sell-offs, but not panic sell-offs. But it is worth noting because, again, who's to say that this couldn't be the one time in market history we get a market bottom without a panic sell-off. If the trend is going to go up and if the market starts trending up, we're going to follow that trend. We're not going to try to be predictor or lock into a belief that we have that's opposite of what the trend is doing. That's how we can lose a lot of money. But it is worth pointing out that it is starting to tick up a little bit on that long-term chart, although it'll take a little while before we would see this indicator start moving off the far left extreme and start moving in this direction. It still has a little ways to go before we'd start to see that. The momentum indicator is in the buy range. It's lagging the other indicators quite a bit. Breadth is in the extreme reversal risk range. What does that mean? Well, it means that it's showing that the market is a little bit overbought. Well, it is overbought. Anytime you're in that extreme range, it is overbought. Now, markets can stay overbought for a while. One thing we look for is, does it get to the far right side? I kind of cut this bar in half and say, okay, is it on the right side of that extreme reversal risk area? This is when you're really extreme and it really is more likely that you're near a pullback area. The market could start pulling back. But even that, just the fact that we're in this range, though, would indicate the market could pull back. And by pullback, I'm not necessarily suggesting that you're going to get a big drop. It could just be a correction within the trend. In the uptrend, stocks tend to stair step. It could just be that you're in this period area right here and you're about to pull back in that little step and then take off again. Or it could be that, the market's been rallying a little bit, you get overbought, it could mean that you have a bigger drop. It could be signaling that you can have a bigger drop. It's just saying that probability shift is shifting more towards a bearish reversal risk, meaning that we can have some sort of a pullback soon. And then again, these are not designed to tell you exactly when a move could happen. We'll look at the price action on the chart to give us a better idea of hey, okay, the market is looking like it could drop. Is there a price action signal that could tell me that drop is imminent or close or underway or what have you? But this is telling me the market mood is turning a little bit more, or could be a little bit more bearish, or it's a little bit too optimistic. Is the better approach, a better way to state this? The market is getting too confident. It's gone a little bit too far, and what happens in those conditions that you tend to get that little pullback tends to take place. The sentiment is really extreme. It's a very extreme level, far right side. We talked about this for a while now. The sentiment has been high for quite a while. So if you were to just say that just because you're in this extreme reversal risk, the market's going to pull back, it should have pulled back a ton over the last couple of years, because it's been in this extreme in this high area for quite a while. There's a lot of complacency in the market, and that gets back to what I've been saying. We haven't seen sentiment get into the fear area during these sell-offs, and especially not into the extreme fear area, which is kind of the panic selling that takes place in a sell-off. So yeah, it's hard to believe that the market is done going down because of that. Now, like I said, that's kind of one thing that I've focused on. It could be that this is the one time it doesn't happen, and so again, I'm trying not to lock myself into that belief that it has to happen. But boy, I tell you, this market is feeling so much like if you were trading or if you're watching the markets during the 2008 financial collapse. I'm not saying that the banks are about to fail like it did back then. Usually when you have these big market panic sell-offs, they're different reasons. 2000, it was the internet bubble, and that caused the big sell-off. 2008, it was financial collapse. I don't know what it'll be or what it could be this time around if it even happens, but during 2000, the lead up to that 2008 sell-off, the big sell-off happened in September through the market ended up really dropping in September, end of September into October, and then it bottomed in March of 2009. But the damage, the move down started in 2007. And then into 2008. I remember there was a period in 2008 in the summer where the market was feeling like it was going to drop, but it just didn't drop. It just kept kind of sluggishly rallying higher. It wasn't rallying high in a strong way, but it wasn't dropping either. And I remember getting frustrated because it was like, man, the market looks like it's going to drop. It looks like it's going to have this drop, but it's not dropping. And I remember getting frustrated. I remember actually losing money trying to trade and getting whipsawed on trades during that period. But the thing was that when the drop did happen, I just kind of stuck with it, and it was like I said, it was frustrating because it was going longer than I was expecting it to go. When it finally dropped, though, I was positioned right for it, and I had my biggest return. Actually, it was my biggest return year ever at that time. I had been losing money for the year in just the whipsaws that had taken place, but I recognized that big drop was coming, and I was able to profit from it. And like I said, I had one of my best years during that period of time. So it's feeling a lot like that. I'm feeling right now a lot like I did in that summer of 2008, feeling like the market had this bigger drop to come. And by the way, we didn't know, there wasn't anything. Well, you had the Lehman Brothers collapse, and I think it was like April of that year. But you didn't, or was that Bear Stearns? Or whichever one was the first one to go. I can't remember if it was Bear Stearns now or Lehman, but the first one happened like in April or May of that year, and people dismissed it. It was like, this is just an isolated case. It's not systemic, and then it snowballed kind of from there, So I don't know what kind of news event would be one that would cause the market to have a bigger sell-off. Nor am I trying to predict that here, but I'm just saying it kind of has that feel. But in the near term, the fact that we're in this far right side right here would indicate that that there's probably a higher probability we get some sort of a pullback here soon, whether it's this week or next week. Now, this is confirmed by the VIX indicator, which we're going to take a look at here in just a second when we go through the list there. But that's something to keep in mind. You can see down here how extreme that is. We're now moved above this red line right here. So we're getting into some pretty extreme complacency area right here. So we got to pay attention to that. All right. On the buy-sell ratios, again, you're looking for extreme overbought, oversold. We're kind of close together right here. The market has pulled back a little bit recently, and so the buys have dropped a little bit. The sells have come up a little bit, but they're coming closer together right here. When they're extreme, it's when they're really wide apart like this. This is a buy extreme where the buys and sells were, the market was trending up a little bit. This was a sell extreme here where the market had dropped, where the sells were outpacing the buys. We're not in that extreme area right here. So what does that mean? It means we can trend either direction from here. Either we could rally up and the buys could take off and outpace the sells, and you kind of have them widen out like this, or we could see a sell-off where the sells start taking off and the buys drop, and it kind of crisscrosses right here. So no extreme showing here. And then on this sentiment indicator, we did hit an extreme. And remember, the market did pull back a little bit when it hit this extreme. We pulled back a little bit here. It wouldn't take much for the market to rally back up into that area and cause and get extreme again. It is elevated though too. So could the market still continue to pull back a little bit right here, and this could drop a little bit further? Absolutely. So we are elevated. We are up in the upper part of this area here. We do want to pay attention to that. Again, these are part of the kind of the market, gauging the market mood right now. And right now it's looking more and more like we could pull back a little bit. Now, what's the significance of that before we get into the charts? What's the significance of that with Chairman Powell speaking tomorrow? Well, we already know that he's going to tend to be a little bit more hawkish, and so there's probably the market is he's less likely to say something that's going to cause the market to really take off. I think that's important to understand about the Fed. The Fed wants this slowdown. They want the economy to slow down. They want to see unemployment tick up. They want to see layoffs. I know that it sounds weird to think that the Fed wants this stuff, but that's the only way we're going to deal with inflation is to get people to stop spending so much money. Okay. And how do you do that? Well, or not necessarily, well, they do want them to stop spending that much money. If people would just stop spending so much money on their own and still be employed, they'd love that, but that's not human nature. When you have the money, you tend to spend it. What kind of forces you to stop spending? Well, you lose your job and now you're living off your savings for a little bit. You're less likely to go out and buy that extra car or go on that expensive trip. All these little things that you would normally want to do, you're less likely to do that. And so that's kind of the idea behind this is to kind of force us into a recession, and then that'll bring those prices back down. And then the Fed can pretty easily start getting us out of a recession as far as what tools they have to use. They've already done it a number of times. What they have trouble with is and what everybody has trouble with is dealing with inflation. You just never know. It can just at any moment it could take off and become hyperinflation. We've seen that in other countries, usually third world countries that don't have much stability. And so, if you're going to pick, okay, inflation's a problem, recession's a problem, which is the easier one to deal with? The Fed is clearly saying recession is easier to deal with than inflation. So let's get us into a recession, and then we know we can if we can get inflation down, then we know we can deal with the recession. So that's what's coming, whether you want to believe it or not, or that's what the Fed is trying to do. And we always say, don't fight the Fed. We always say that during periods of prosperity. The market's going up. Don't fight the Fed. They're lowering interest rates. Don't fight the Fed. And we always use that as a reason to buy and buy and buy. Is the Fed's right behind you? They want you to buy and they want things to go up. Well, right now the Fed wants things to go down. They want unemployment to go up. They want to slow the economy, and so the saying remains the same. Don't fight the Fed. The Fed is wanting this to happen, so don't fight that right now. We don't want to be we want to be mostly in cash. We don't want to be going out there buying too heavily in this environment because you're going against what the Fed is doing right now. Okay, so it's important that's an important part of gauging market mood right now too, which is, I'm painting kind of a gloomy picture here going into the holidays. By the way, typically the holidays tend to be a bullish time of the year, but so is kind of the Thanksgiving period too, and it wasn't overly bullish, and it makes me really wonder if so many people are dismissing a market sell-off into the end of the year. In fact, a lot of people are saying we're going to rally into the end of the year just because it's seasonally bullish. And the contrarian in me and the way I'm looking at the charts is saying, man, it might be the opposite. And by the way, that's what can fuel a panic sell-off, is when people are convinced that something's going to go higher and it doesn't, and now they don't know what it's going to do, and they start running for the exit at the same time. So anyhow, let's take a look at the charts here. The S&P chart, there's a couple ways I'm looking at this. Obviously, I've been talking about this is a potential bearish ABC pattern right here that could lead to a bigger decline. I've talked about this downward trend line. And if you remember last week, I said this trend line, anyone that knows how to read a chart can see that trend line, that knows that trend line. And everyone's talking about this declining trend line. You go on to CNBC or Fox Business station, whatever news item, if you look at those market channels or what have you, or websites, everyone's aware of this trend line. So what I was talking about last week was, part of me thinks that one of two things could happen because everyone's focused on this area, that either we start reversing ahead of it, we don't quite get to it, and we start dropping, or that possibly we punch through it where everyone thinks it's now, smooth sailing from here, and then it reverses and sells off. Now, obviously, this backs up a little bit of a bearish bias that I have right now, and other people you listen to might have different opinions. They might be a lot more bullish on the market and believe that. And by the way, if we do break that trend line, you have to acknowledge that is more bullish, and that possibly the market is reversing its trend. Now, the Dow is definitely looks different than the other indexes. These look like they've been lagging. The S&P, the Nasdaq, the Russell. The Dow has really been the only one that's really looked bullish to me. In fact, we can look at that chart here. Just flip it over to the Dow chart. You can see this definitely looks like a uptrend right here. It's really an impulsive move up. It doesn't look real choppy and doesn't look like it's lagging. We've also, I told you, we were watching this previous high right here. I thought maybe as the S&P bumped into that downtrend line, that the Dow would stall and hit this resistance line right here. I'll zoom in a little bit and we can see this a little bit more detail, but it actually broke out a little bit above it. But again, this could also line up with what I was just saying, where with the Dow breaking above, maybe it's the Dow that breaks above there, and maybe maybe it's the S&P that doesn't quite get to that resistance area before the market starts selling up. See, it broke out above here, and then yesterday it had this bigger drop. Now today it's trying to hold up right here. It's today I would characterize as a pause. Could it end up being a reversal back up again? It could, but as far as reading it right now, it's just a pause. But that's worth noting that the Dow has been breaking out. Now, if you're trying to analyze this as far as, okay, obviously the safest place to be in a bear market is in cash. And if you don't know what you're doing, you should stay in cash. But if you want to try to do something, what we're doing in the portfolio is we're trying to do some things that we don't normally do, but trying to do some things to make a little bit of money while we're waiting for the market to bottom. We're being very selective with what we're getting into. We're trying to focus on areas of the economy that are working. Things like consumer staples have been working pretty well. Oil, energy trades have been working pretty well. Some of the defensive stocks, or defensive meaning, the building weapons and war type stuff is working pretty well for obvious reasons. What we're staying away from, and it's been obvious, is technology, chip stocks and other technology stocks that have really been lagging the market. You can see a lot of the Dow industrial stocks have done very well. That's why the Dow has been outperforming. There's a lot of consumer staple type stocks in the Dow as well. Things that you're going to buy no matter what the economic conditions are. Walmart, you're still going to shop for things, groceries and stuff. But that, this is what's telling you. This is telling you what's working. You want to be staying away. You might have traded the FANG stocks all through the big boom over the last few years and done very, very well with those. But those aren't. The market is not telling you that those are working right now. In fact, just the opposite. They're telling you to get out of those stocks. Apple's getting beat up again today. That's been guaranteed money for over a decade or two now almost. But it's not the place to be right now, is what the market is telling you. All right. Now, what we don't know what's going to happen in the longer term there. I still can't tell from this chart whether it's, we're going to have a bigger move down or whether it's just going to be a smaller move down, because the other possibility is that this is just a wave A, wave B, and this is wave C right now that we're in. It just maybe comes down here a little bit, and then it pushes higher, and maybe we do break that trend line. Maybe it does start to move up again. I still have to recognize that as a possibility. Now, what I was saying earlier in the update, this is what I was talking about. This is what was kind of happening in that summer of 2008. We were rallying a little bit, but it was real choppy and it was looking corrective. And I kept waiting for that bigger decline. And if you've been following me for the last several weeks, since you know that back here we had this bearish reversal. This looked like a bearish ABC pattern right here. We had this big decline day. I thought for sure that was starting a bigger move down. It didn't. We rallied back up into here. We had this bearish reversal candle saying the market should drop a little bit. It did drop a little bit. I thought, boy, could this be it? Could this be wave A, B, C? And now we're dropping. It didn't. And so you start expecting this bigger drop, and it's not happening. Now, one other thing you have to pay attention to here is that, here's a big move down right here. We're beyond, a little bit beyond a 50% retracement of that move down. Well, now we're still technically in the retracement zone. It's between the 38.2% and 61.8%. Those are Fibonacci numbers or levels. But we are getting to a point where we start going up much further, and it becomes less likely that this is a correction for a move down. And we have to look at the probability that, maybe we're in an uptrend. I mean, these corrections within an uptrend, these corrective moves right here can look a little bit like an uptrending behavior. We are getting higher highs, higher lows. So in an ABC pattern, that is a look to an ABC pattern, at least for a little bit. You'll get that higher high, higher low look to it, and then you get this big drop. It's just a correction, ends up being just a correction within the downtrend. So when we learned about ABC patterns, when you first learn about ABC patterns, you get excited. You think, man, I'm going to be able to know exactly what the market's going to do now. And then the market reminds you that, no, you still can't know exactly what it's going to do. There are some variations to it. And that's why you don't see me focusing on just one thing. I try to look at a lot of different clues. I'm not trying to predict something as much as I am trying to gather evidence and come to a conclusion out of that evidence. And the more evidence I can gather, generally, the more likely I can, better picture I can get as to what could happen next. Sometimes you start getting conflicting data, though, and then you get that paralysis of analysis. We want to avoid that. And this is why you'll see me look at two sides here. I'm looking at a bearish argument and a bullish argument. Even with the bullish argument, though, I'm still, even if in the near term, it looks like there's still a pretty high probability we have a little bit further to drop. Because if this is wave A, wave B, wave C, we still need to pull back probably into this area right here at the very least. Maybe a little bit further than that. But, then you start to see any sort of bullish reversal. By the way, yesterday was a bearish candle. We had this attempted rally right here, and then we had a pretty good drop yesterday. We did come off the lows a little bit. A lot of times when you close right at the lows, it's even more bearish. That could be a reason why we're seeing a little bit more indecision. But like I said, the price action today is indecisive. We call that a spinning top candle formation. It looks like those little spinning things people, kids used to use. We're getting to an age where new generation has no idea some of the things that I'm kind of right at the edge there. I didn't really play with those spinning tops when I was a kid. They were still around, but now I remember talking about spinning tops. My kids have no idea what the spinning top is. They've never seen one before. So might have to change the name here pretty soon to where the new generation knows what we're talking about. But that's an indecision candle. Now, we still have an hour and a half before the market closes. That could change and look different by the end of the day. If we were to close at the lows of the day down here, that would still look very, very bearish. It would look a lot more bearish than indecisive. If it were to close at the highs of the day, it could look a little bit more bullish near term than bearish. But either one, not indicating a strong directional move either way. Even if we were to rally a little bit, it wouldn't look like you would get a strong rally out of that. So again, the market is looking more bearish right now going into that Powell speech tomorrow. I believe it's tomorrow morning. So my tendency would lean towards the market reacting more negatively to that news. But like I said, this is where the market looked very negative back here, and then we had that CPI report, and it jumped up. But notice what happened. It jumped up for 2 days, and then it hasn't gone anywhere. We really haven't gone anywhere since then. We've been in a sideways range since then. So to say that the market loved that CPI report, I disagree. What that CPI report did was scare all the people that were short the market, cause them to get out of those short positions, but it didn't attract new buyers to come in. Maybe a little bit on the Dow stocks, but not on the S&P, not the broader indexes. Didn't really cause anyone to take on any risk with some of the tech stocks or anything like that. We haven't gone really anywhere since that CPI report came out. So, yeah, there's two ways you could look at it. You could say, well, the market's, kind of digesting that. They're waiting for another positive news event to take off, and that could be right. We could get a little bit of a drop here and then take off again. But you could also look at it as, man, we should have taken off right here. There should have been some follow through to that initial exuberance, and we're just not seeing it. And that could lead to believe that any sort of negative news that comes out could drop the market, especially when we're already in an elevated level of complacency. So the market is at this extreme complacency, but we haven't gone anywhere for 2 or 3 weeks. That's a problem. That's usually a sign that if you haven't found a reason to buy in this extreme complacency area we're in, then what's going to cause you to buy? And then on the flip side of that, if nothing in this environment has caused you to be confident to buy, that means it's going to be easy to get you to sell, because the market doesn't need buyers to drop. It can drop with just a lack of buyers, or not. The market needs buyers just to stay flat. The market needs buyers just to hold right here. So it's kind of like trying to ski uphill or something. Okay, as soon as you stop that effort of trying to ski uphill, you're going to start sliding back, right? It's not that you're trying to go down; you're just taking a rest. But you're on a hill. The momentum is going to pull you down every time, and it takes so much energy just to go up. That's what the market happens in the markets. You could say, well, okay, the buyers are taking a break, or there's a lack of buying right now. There really isn't any selling. I don't see any selling going on. Okay, but that's a problem still, because it takes buying energy just to hold, and that's what's kind of the market's feeling like right now. It's just feeling like it's trying to just hold right here, hold these gains that happened a couple of weeks ago. So it puts it in a dangerous spot to where if there is anything negative that comes out, the market's in a mood where it's probably going to be more likely to sell off of that. It's less likely to ignore the bad news, in other words, to shake it off, than it is to react to it. It's probably more likely to react to it. Now, again, I'm going through all this, and like I said, I don't lock into this stuff. I could be up here on Thursday and have a completely different argument. I could be bullish on Thursday, where I'm a little more bearish today. Like I said, if the charts start taking off and I see some buying, if we start breaking out of this range here, we start moving up above these highs right here, and you see good market breadth behind it. Well, I shouldn't say I'm going to flip-flop very strongly, because those sentiment levels are still so high. I would still view that as any sort of rally is probably going to be temporary. We still probably have a bigger downside coming, just to correct that extreme complacency that the market is in right now. Let's see here. Market. Oh, gaps. Since gaps usually get filled, to the market gap, you say get up to 380 to 386. Gaps do generally tend to get filled. I'm trying to see, are you talking about this gap right here? Gaps do tend to get filled, but first of all, not always, and not always in the time frame that we're expecting them to get filled. Gap filling is a little bit more likely in commodities. So people who are commodity traders, they really get focused on gaps getting filled. They get obsessed with it, and then because it happens all the time in commodities, and then they when they bring that over into equities, they find that it doesn't happen as often in equities as it does in commodities. So that is an area there you can focus on if the market does. If this ends up being a wave A, wave B, wave C, and it's going to go higher, then both of these, this area right here and probably this area would be more likely to be a target of where it might rally to before you'd have to start looking at another pullback. Now, we've already seen the Dow break above this high right here, this September high. It's already broken above that. And you can say, okay, well, it's leading the way, and so these other indexes are going to eventually break above that September high. The problem, though, and this is what I've been talking about for weeks, is that the Dow is not typically the leadership group. It's usually the NASDAQ or the Russell 2000 that tends to be the leadership group. They tend to lead the way. So with the NASDAQ and the Russell 2000s lagging right here, they're not participating in the rallies very much. Again, that's another signal that it's building. To me, it's a signal that's building towards another move down, as opposed to we're starting a new bull market and the Dow is leading the bull market. I just don't see that happening. Well, it's just hard for me to see that based on just my 23 years of experience, or 25 years of experience now trading the market. So, but that is something, if we do rally, that's definitely an area there that you'd want to pay attention to, both with filling that gap, and also that'd be the previous high on this drop down right here. This would be a resistance area that you'd look at to rally up to. Now, again, don't forget that downtrend, because these have kind of lined up at about around. There's a intersection point between that downtrend line and, well, actually it was this one right here I was looking at. Actually, we've kind of moved beyond that. That was back in here when we were looking at this area right here. Not as much intersection point there. Oh no, we were looking at this one right here. Yeah, there's an intersection point with that one. That's the September high. Sorry, I was looking at this high. There's a September high. Yeah, there's a little bit of an intersection point with that downtrend line. Absolutely, that could be a resistance area if we move higher from here. Yeah, if I am sounding a little bit more bearish today, a lot of it is coming from yesterday, because yesterday's price action was pretty bearish, and so I have a tendency to lean a little bit more in the near term, to be more bearish in the near term because of that, and I'm kind of going through some of my reasons for that as well. We looked at the Dow chart. We'll quickly just look at these. You can see so here's the NASDAQ 100. It's lagging the most. This really looks like a bearish ABC pattern right here. But again, you can't dismiss that this could be wave A, wave B, wave C. may not have that much further to drop before it starts to rally. That's what I'm saying. By Thursday, we could see a bullish reversal, and we could be talking about this is a bullish ABC pattern, and maybe we're moving up to some of those other levels. All right, here's the Russell. You can see again. Just notice the choppy behavior. This is looking corrective. When I say impulsive or corrective, impulsive means you're moving sharply in a direction. So if we analyze the Russell 2000 to the Dow, this looks really choppy and not sideways as much, but sluggish. Looks a little sluggish. And then you compare that to the Dow chart. This looks decisive. This looks impulsive. Look at that. There is some back and forth, but it doesn't look sluggish at all. Look at the angle of that. If you were just to connect the lows, so you can look at if you connect the lows, if you were to draw a line, connect the lows, and that's looking like a sharp upward direction. You do that to the Russell 2000, it's still up, but look at that angle. It's a different angle, much different angle. It looks a little bit more sluggish. But believe me, you could go out there and find charts where a stock behaves like this, and it just keeps going higher and higher, and now it's breaking out to new highs, and that was the bottom. You can go look back in hindsight and say that was the bottom. So that's why we try not to get so locked into trend behavior that we ignore what's actually happening. If we keep trending up, we will keep trending up. Now bonds, I talked about how this is looking more like a trend reversal here because if you were looking at this as A, B, C. Now if this is wave C is now 2 to 3 times the length of wave A, which is usually rare. Usually you're not going to see something like that be that stretched. And so to me, this is looking more like you're in a little bit of a trend reversal in bonds. Now we are down a little bit today. It'll be interesting to see how we pull back right here. Do we move a little bit more sideways? This looks a little bit more impulsive up right here. So do we see a little bit more of a choppy sideways move? That would be more indicate that we're more likely to keep going up. Now, if we start dropping dramatically over a few days, and we're down to here by Thursday or something like that, that'd be a pretty dramatic drop in 2 days. I wouldn't expect that, but if this is looking like it's dropping again, you get down to these levels again, you'd have to change that outlook. But this is a pretty good stretch right here. Obviously you've broken the downtrend line with that move. This is looking less like a wave C, more like a wave 3, where this is wave 1, wave 2, you're in wave 3, and you get 4, 5. We'll keep an eye on that though, because that could be significant if the bond market is starting to change. It's the market has been kind of moving down when bonds have gone down and up a little bit when bonds have rallied, which is actually not. That's actually the ironic thing is during a lot of bull markets, when bonds rally, you see the market drop, and when the market drops, you see the bond, or when the market rallies, you see bonds drop. It's almost the opposite effect. That's why you don't want to get too locked into some of these correlations, because they're not always correlations. It's same with like the dollar and commodities we always talk about. They tend to be move in opposite directions, but there are times where you can see where they move in the same direction. So they're not always inversely correlated. But that's something to keep an eye on. I'm going to speed. Well, I was going to speed through this, but gold is something I want to start paying attention to. I've kind of been very dismissive of gold, and a lot of that lately has been because I've always heard that gold should rally in an inflationary environment, and it hadn't been for the longest time. We'd seen this big decline in gold all through the summer, when the market was or when inflation was high and getting higher. But I've been thinking about this a lot lately because of this move right here in gold. That's an impulsive move right there. And if you back out a little bit, you can see we've broken a major downtrend line. So you can see that gold had been stair-stepping down here for the last year. And we broke that. We broke that with an impulsive move up. And I think gold is in a trend reversal. And again, I'm trying not to spend too much time on fundamental reasons because the charts are all that really matter. But part of the reason why I think people haven't fled to gold during the initial inflationary environment is because they haven't felt they've needed to. One thing that's bothered me so much during this whole decline in the market, I've talked about this numerous times, but what's bothered me is how sentiment has remained so high during this decline. It's not normal to see sentiment so high. In other words, there's just been no worry about the selling, no panic in the selling. And this is why I'm really starting to think we're getting close to a panic sell-off. Because I think what's going to really force people into gold, why I think gold could really start taking off from here is, like I said, there hasn't been a reason to do it. And why would people go to gold? They go to gold because they don't trust anything else. It's always held its value. Gold has been in the history of the world. It's been the thing the only currency you could count on to exchange. It's always had worth. But I'm thinking about my own situation, and even though I know a recession's coming and things like that, and inflation's been high, and yeah, you're always worried about, are you losing wealth through inflation? Are you making enough return to offset what you're losing in inflation? I'm starting to get concerned about that now. We haven't had to deal with inflation for so long that you really haven't worried. It's been pretty easy to outpace inflation with most investments out there. I mean, just holding Apple stock, you're going to outpace inflation. But I think people are realizing right now that it's now a problem, and they haven't had to deal with that problem forever, for a long time. And I think that there's going to be a big movement into gold at some point here, because there's going to be real concern with there's going to be a panic that's going to cause people to want to have something to hold on to. Look at what happened with Bitcoin. People were starting to say that Bitcoin was replacing. The reason why gold isn't rallying is because Bitcoin is the new gold. Well, how many of you feel confident owning Bitcoin or cryptocurrencies in general over gold? Now, crypto markets are not big enough to, everyone that knew anything about the economy kind of laughed that off, because they're like, Bitcoin itself is not big enough to replace gold as a currency. It's it's not even. It's laughable that it's not even close. But you're seeing the result of how ridiculous that thought process was right now with these crazy things that are going on with cryptocurrency. So. I'm making a little bit of a bold prediction here, but I'm not locked into it yet. But it's interesting because this is the first time in a while. I mean, look at all this just going nowhere, and then this was trending down, and this has not been something I've really even been focused on for at least 2 or 3 years. I just haven't been focused on gold. And when I tried to trade it, I've been caught in this wash right here to where I really haven't made money in it, and even on some of these moves, to where it's just like not worth my time. But now I'm thinking it's worth my time, because I can start to see not only the chart reasons to believe it could be starting something significant here, but some of the fundamental reasons. And again, I'm not a fundamental expert. I'm not a gold expert. So you can take what I just said with a grain of salt. There's definitely people, even people I work with, that are bigger experts on commodities and things like this than I am. But I just keep an eye on that. Now, I'm not, from a near-term chart here, from a 6-month chart, I'd be careful about running out and just buying gold right here, because this looks like a wave A, this looks like wave B. And it looks like in the near term, we could have maybe a move down. I'm talking about filling gaps, maybe fill this gap right here for wave C. And then maybe down in this area right here, it takes off again. But a lot of that could depend on the dollar. So how can you trade gold? You can trade it just with the ETF, the GLD, or you can look at some of the gold mining stocks out there. Maybe on Thursday, I'll take a look at gold mining stocks to see if there's any good patterns on the stock specific class on Thursday. Now this is correlated with the dollar quite a bit. So let me skip over to the dollar. We'll come back to oil. Now the near term, and this could correlate actually pretty well. Near term, this could be a bearish ABC pattern on the dollar. We might see the dollar rally up into here and then decline again. That could cause, remember, gold, commodities and the dollar tend to move inversely. So if this has a little bit of an upward move, it could have a little bit of a downward move in gold, which could create that wave C, and then gold could take off if the dollar drops. This could also, now the market has been following the movement of the dollar. When the dollar was dropping, the market had a little bit of a rally last week. Yesterday, what happened? We had a big drop. We had a big rally in the dollar. We have a little bit of a rally in the dollar today. It's kind of sluggish, but in the market's kind of sluggish. So again, I'm a little bit bearish in the near term. Could this be a wave C in the dollar that causes the market to drop a little bit further? Maybe it's just a wave C down in the markets as well. The market has been following the dollar right now. It's not always going to do that, but we're going to pay attention to that. The days the dollar's up, the market's been up. The days the dollar's down, opposite of that. Days the dollar's down, the market is up. Days that the dollar's up, the market has been down. And so until that changes, we're going to be paying attention to that, right? It's going to give us a little bit of a clue of what the market direction could be. We can go back to oil. Oil, I talked about that December 4th meeting. That's going to be a catalyst for oil. We don't know yet which direction, but I didn't like that. You know, one of the things I've been talking about was I wanted gold to hold this support area right here, and it didn't. We've broken below that. Now, we had a bullish reversal candle yesterday, indecision candle today. We're back above that support area, but not very strongly. We're trading lower than where we opened, although we're higher than where we traded the day before. That's actually a bearish price action today. This is going to be a key low right here. I'm going to want to see this low hold. It could still drop a little bit lower. Could you get a double bottom here? You could, but I'd really like to see a higher low, have this hold. I thought that's what was taking place right here. Kind of the same thing happened here, where you had an upward bullish reversal candle and then an indecision day, and then we came down from that. We'll see if the same thing happens here, if this ends up going lower. But the overall chart of oil has been sideways, really. If we back out a little bit, you can see. But lately, I just haven't liked. I wanted to, a lot of things I look for in these declines is, does it look like you're moving up the right side of the bowl, so to speak? We were looking that way right in through here, but now, we're still working on the bottom of the bowl. And maybe that bottom is lower. I don't know, but it's creating a bit more of a question mark over the last few weeks, at least in my mind. And And so, yeah, it'll be interesting to see how things look ahead of that December 4th meeting. We have another. I think we have another couple. I know we have this class. What is the 4th? The 4th is actually, is that Monday or is that Sunday? That might be Sunday. So we'll have to see how things look on Thursday. That's coming up pretty quick. I still can't believe we're right at the end of November here. All right, I got to speed up. We're running out of time here. So I do want to focus on the VIX. VIX spiked up a little bit yesterday. Now, this is the VIXY. This is really the only way to look at the VIX indicator on TradersPro, but it's a little bit different. You don't get the same numbers here that I like to look at on the VIX indicator itself. Now, you can't trade the VIX itself. This is an instrument to try to trade. It's kind of trading the future. VIX futures is basically what it's trading. So I like to look at I like to go to another charting service and look at the VIX, and you can, if you got another charting service you can use, you should be able to just type in VIX and it'll pull up. But one thing I wanted to point out, I've been talking a lot about every time we've gotten around to 20 on the VIX, we've seen the market sell off. The market's going to move inversely, typically going to move inversely to the VIX. Well, on Friday, Thursday, or Wednesday, before the Thanksgiving weekend, we got down very close to 20. It was just a little bit above 20. What was the low of that day? It was 20.32. Now, one of the things I told you is we're not looking for exactness. You can see that we moved down below 20 right here, and we stayed there for a week before we started to see the market sell off. Back further than that, we dipped below 20. We got down into around near 18 before the market sold off. But every time we've been down around this area, the market has tended to sell off. So this is, again, tying into that market mood. This is showing that the market is very complacent right now. It's not worried. 30 is when the market is fearful. I've been looking at 40 as panic. If we get above 40, I believe that's going to show panic in the market. Although I think it'll go beyond 40 especially from these conditions we've been in. I think we'll spike up well above 40 in a panic situation if we get it. But when we've gotten up around 30 or above 30, the market has tended to rally recently. And when we've gotten down to 20, it's tended to pull back. So from that standpoint, again, this is really leaning heavily into a near-term pullback. Now, again, doesn't mean it has to happen exactly. I would say, though, within a week, we should see a decent pullback in the market, a week or two. So let's take this week and next week and say somewhere in that time period it should happen, because even back here where it stalled out a little bit, there's about a week before it starts selling off. But we don't want to be strong buyers in this environment right here. And one of the things I did in the portfolio yesterday was I added the inverse. I'm going to skip over these other ones I normally look at because we're out of time. We'll take a look at them on Thursday. But in the portfolio here, I added the SOXS. This is the inverse of the chip sector. When the chip stocks go down, this will go up. Now, again, this could just be A, B, C, and I might be just in this for a couple days, maybe just till Thursday. But that's my hedge. If the market drops, this should go up and offset a drop a little bit. The other thing I might consider doing, I might lighten up. Well, I don't know. I've got a lot of energy stocks, and that December 4th meeting, we could see a move either way, and the portfolio, there's some stocks that have done pretty well. Natural gas, again, I don't see a reason to get out of this one. Marathon Petroleum, we pull back a little bit. This one still looks okay. Tech is not oil, but has a nice move today on the down market, so I'm kind of staying in this. So this has been a little bit sideways lately, but CEIX just exploded the last few days. This is a coal stock. We've been waiting for this move for a while. I mean, we were kind of anticipating this for a while. It's finally paying off. And look, I almost got stopped out right here. I'm very close to getting stopped out and missing the move, but we caught that move. But now we're in the far right side of the extreme reversal risk, and we're bumping into this resistance area right here. So I'll have to, if I do want to lighten up on energy ahead of that meeting, maybe I'll take some profits on this one. I'll wait till Thursday to make that decision. That's something to keep an eye on. GF, man, this one I might get out of at some point just because we're not going anywhere. We're stuck in the sideways range, but again, I don't see that there's not necessarily a reason to get out. So just hang on to it. ADM. These are consumer staple stocks, and they're agricultural stocks. So these are things that people are going to need, whether the economy is good or bad. These have been working pretty well. And then I have that hedge with the SOXS. Now, we're not doing much. We're still, we did hit 140. I've been trying to get above 140. We've been stuck in the 130 to 140 range for a while now. We're just trying to grind out some gains if we can during these conditions, these bear market conditions. Now, as far as individual charts, I don't have much time, so I'm going to some people tune in just for that. So real quickly here, under the muscle stock tab and the new buys, I've been going here a lot lately. I talked about this one on last Tuesday, the AXSM. I like that pattern. Remember, it looked like we were moving up the right side of the bowl. We had this little pullback, look like a higher low right here. We got a new buy signal right in this area here. Let me switch this over to signals. And bam, you got this big move up. Now, if this is kind of a bull pattern, typically you'll move up into here and then you'll move sideways. We did break out, so what we might see is it move sideways and kind of form that handle right through here. Might consolidate a little bit. I don't know that I'd go chase this one just yet here. You kind of missed the move if you didn't get in ahead of time. Let me give you another one on this list. ARGX, the biotech stock. We're seeing a lot of movement in biotech. I'm going to have to take a look at the sector here because we're seeing a lot of these show up. But again, I like this kind of it looks like it's kind of coming out of this corrective move. Got a little higher low right here. A little bit of resistance up here. I kind of like that pattern. And then we'll do this one right here, CNC, another medical stock. Again, big drop right here, impulsive up, corrective. This looks like it's a higher low. Looks like we're working our way, but now you could wait for a breakout right here to get a little bit more confirmation, especially in these market conditions that are looking a little bit more bearish in the near term. But and it went to a buy signal and then went back to a hold today. So you could kind of wait to see if it breaks out of that. But those are two that I kind of like. All right. I'm just reading that long question here. Hopefully I can answer that here. Yeah, I kind of get the question is the software is really designed to be a trend following software. And it is going to work better in bull markets, and that's what we're kind of waiting for. The bottom line is the best thing, and I say this all the time, best thing to do in bear markets is to be in cash. Wait until the conditions get better. If you're really good at trading back and forth, you can short stocks, you can buy stocks, or what we've done is we've used some of these inverse ETFs that will go up when the market goes down, so we don't have to short the market, but we can still profit from it going down. What I'm doing in these classes is going to be completely different when we're in a bull market condition. If you want to go back, if you go to the YouTube channel, go back 2 years or even just a year. We were still in a bull market last year around this time, and go look at how the class layout was. There's a process there that I went through to use the software. Best to use the software in that condition. It is going to work best in a bull market condition. But I would argue this is the best time to educate yourself. Trade a little bit in these conditions. Don't get crazy. Find stocks that are outperforming and limit your exposure. If you look at the portfolio again, I look at how much cash I have. I have $83,000 in cash. Most of the money is in cash, but then the areas I'm getting into are the areas that are working. Consumer discretionary stocks, energy stocks. And I'm trying to make a little bit of money while I'm waiting. But this is a great time if you're just getting started to learn, educate yourself, learn how to read a chart, learn how to read those candles or the price action, learn how to use the software. Even though you may not be trading and it may not be, obviously it's not trending up with a lot of stocks. You have a lot of stocks in these uptrends. Just learning how to use the software, even if you're just paper trading or doing simulated trades, get the education down so when the market does turn, you're not just starting to learn at that point. All right. Any other questions? Make sure you email those to me. I'll be happy to answer those for you. Have a great week, everyone. We'll see you on Thursday for the stock specific class. Bye, everyone.